Welcome back. One of the biggest trends for big investors this year has been the SPAC, Special Purpose Acquisition Companies. Today, we're shedding some light on how they're doing so far and what type of SPAC leaders are outperforming. Who else but Leslie Picker joins us with the SPAC story.
Hey, Steve, good morning. For a group of hedge funds known as the SPAC Mafia, the trade goes something like this. Buy shares in a SPAC's IPO, hold on until a deal is announced, where typically you'll see a pop, and then sell shortly thereafter. If the stock doesn't pop, investors in SPACs can redeem before a deal at the price they paid for the units plus interest and warrants. In other words, there's embedded downside protection. A recent NYU study looked at 13F filings and found on average 90% of professional investors divested their SPAC holdings before the deal was closed. So then the question becomes, who's left holding the bag, and how does the SPAC perform after the mafia moves out? Our data team here at CNBC pulled the median return for SPACs that have announced or completed mergers this year. That figure was just over 5% as of November 20th. But history shows that SPACs can be a losing proposition over the long run. That NYU study found that 12 months post-merger produced negative returns every year going back to 2010. Some say, though, that the caliber of SPAC managers this year could lead to better returns in the future. Steve.
Leslie, thanks. I have a question for you from, my economics beat here. I hear new initials in the finance industry. I hear blank check and I get nervous. How much systemic risk do you think is embedded? Are SPACs small enough not to be an issue? Or is it something that if it goes bad, we're going to be talking about bailouts and things like that?
I don't think there's systemic risk per se, but there has been a lot of money that's gone into this space, $70 billion year to date. There have been 200 of these things. And as I mentioned earlier, one key tenet of SPACs is that they do have this downside protection. So I think that would be the SPAC defense to being some sort of systemic risk. The real risk that comes from these things is that they raise all of this money and they aren't able to find a deal. And so therefore they have to essentially everybody redeems the sponsors could lose some money there. But I don't really see much in the way of systemic risk per se, at least in the short run. The long run, if you do see kind of like a deal frenzy and people aren't doing due diligence and they're paying up for valuations, and then down the road we look back and say, wow, those were some really awful deals. Right. People lost their money. Then I think that's where kind of the reckoning could take place. But I don't know if that's necessarily a systemic risk to the financial system.
Shepard Smith here. Thanks for watching CNBC on YouTube.